Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to look at the definition of long-term debt. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at an example and give you a little more insight into how it's used. Long-term debt appears on a company's balance sheet. Long-term debt is a non-current liability, including loans and financial obligations lasting more than 1 year from the date of the balance sheet. Long-term debt for a company would include any financing or leasing obligations. Such obligations would include company bond issues or long-term leases, which have been capitalized on a firm's balance sheet. Now let's look at an example. As stated in the definition, a long-term debt for a company will be found on a company's balance sheet. We'll be, for this example, looking at Walmart Stores Incorporated, the balance sheet, the annual data, starting at the January 31st, 2012. And we'll move on down here to the liabilities section, about halfway down. And you will notice under the once you get past the total current liabilities section, you get into the long-term debt, and this will be right here. This again is long-term liabilities. It's not current, meaning that it won't be due within the next 12 months. It'll be actually longer than that. It could be 1 year and a day from that point moving forward. It will be found in this particular area here, long-term debt. Long-term debt, like any debt, is beneficial to a company at times, and at other times it can really wreak havoc and actually drive a company into bankruptcy. The idea here would be that a company may decide that they're going to go borrow money from the bank and say that pay 3%. They turn around and they can do something with it that will produce 6%. Well, then they're going to make 3% on the difference there. That's the idea of using long-term debt. They try to make more money than it actually costs them. As long as they can do that and make more than their interest payments are, then it's profitable. But lots of things can go wrong down the road. There's lots of unforeseen issues, and business may be running one way, and then down the road they find out that they have competitors that squeeze their margins, or many different things that can happen, and it causes problems for the company. The real issue here is to recognize that a company with no debt is a strong company, and a company with little debt is a strong company. These companies tend to be really strong and capable of financing their own growth without using a great deal of debt. One of the rules that I use whenever I'm looking at companies from fundamental analysis perspective, I try to find companies that have enough cash on hand to pay off all their long-term debt if they so chose. And that would be a great sign for me that a company is very strong, at least able to make a lot of different choices there. Whenever you're looking at long-term debt, you want to analyze the previous data like we're talking about here. We're looking at 2012 here. You can see it's $47 billion in long-term debt. The year before that was 43. If I move this over a little bit further, you'll see it was 36 billion. So you can see that their debt is actually increasing here on Walmart for the past couple of years. That's said to be deteriorating. Whenever you have a company that's growing their debt over time and seeing at the same time their cash decreasing, and which is what's going on right here, you can see that you have 7.4 billion and 6.5 billion, and previous year before this over here. So you had 8 billion, 7.4 billion, 6.5. So you can see that this is actually a balance sheet that is getting weaker, not stronger over time. If that were the opposite, to reverse the situation, if you were to see a situation where you had maybe cash was at 6.5 here, 7.4 here, and 7.9 here, that'd be improving. You'd also want to check and make sure that the actual debt was doing the same thing on long-term debt. If it was also decreasing, that would be, people would say, or analysts would say, that the balance sheet is improving. To compare one company against another in a particular industry versus the debt, the amount of leverage that they're actually using, the way to do that would be to use the debt-to-equity ratio, and we'll go over that in another video. For now, don't try to compare, this, for example, don't look at, the 47 billion of long-term debt on Walmart and then try to compare that number to Target or something of that nature. The companies are two different sizes. Their debt levels would obviously be different. To actually get a fair comparison, you'd want to use the debt-to-equity ratio, and we'll talk about that, like I said, in another video. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result.
These videos are for educational purposes only.